Hi, everyone, and welcome. I'll get right into it because we're preventing you from going to your beer. If you all could introduce yourselves, that would be great.
Hi, everyone. My name is Vanessa Gerlay. I run a Web3 early stage fund called Aglaé Ventures. I started my career in traditional finance, working for about 10 years at the New York Stock Exchange, doing acquisitions and investments. And then I became one of the first employees at Consensus in 2016, stayed there for a few years, and then joined a few different investment funds.
Great. I'm Rob Haddock. I'm a general partner at a Web3 fund called Dragonfly. We're a little over $2 billion of AUM. Prior to that, spent a decade on traditional finance, launched crypto at a large hedge fund, spent a decade doing both growth equity investing and M&A within fintech and technology companies.
Hi, I'm Samantha. I work for Rockaway. We're, since 2018, a crypto venture fund. We invest across stages, but primarily early stage companies, tokens. I'd say we're very technical. We have an engineering team that tries to dig in with the protocols we back. Prior to Rockaway, I also started my career in traditional finance. I got, I guess, closer to startup world, and then a little step back to VC, and I was at DCG for about 4 years prior to joining Rockaway.
Hi, everyone. My name is Leo Groen. I'm a managing director at Spartan Group. For those of you not familiar with us, Spartan Group is a venture capital firm and digital investment banking group dedicated to this industry. We're founded by 3 former Goldman partners based out of Asia. We have our offices in Singapore and Hong Kong. I'm based in Switzerland, and we cover the globe from early stage venture. We run a liquid hedge fund as well, and one of the most active M&A and deal makers in the space. Pleasure to be here.
Great, I'll get right into it. 41 billion over the past 18 months, and yet I just saw a PitchBook headline today that said the US-based VC funds posted their worst quarterly return in 10 years. What is it like on the ground for allocators and VC funds just like yourselves?
So I saw the headline too. I think this encompasses all VC funds. So we're in a very specific category where we can invest in equity, but also equity and tokens. And that has a very different return profile than traditional equity. So think about it when you invest in a Web2 startup. If you come in early, maybe the startup will do all the series. Maybe they will be acquired. Maybe they do an IPO, but the chances are very slim. Whereas if you invest in core protocols and really good teams, there is liquidity exit that comes in after a few years. So it's very different than what we see in the Web2 VC space. The other thing is a lot of the VCs also have liquid strategies, which suffered greatly, I would say, in the past 2 years in the crypto space. So I would take that with a caveat, that general statement. I don't think the Web3 funds are in the same situation. I think a lot of funds raised a lot of money before everything collapsed and have a lot of dry powder and have kind of stopped investing when everything was overvalued.
Yeah, I mean, listen, I think I agree with some of that. I think broadly though, we are in some of the same situation that everybody is, and it's a venture problem, and it's less of a crypto problem, and there's very specific reasons that crypto is top of mind. But outside of AI, crypto funding is venture funding is basically dried up, right? And this is true because people are worried about raising their next fund. They really want to extend their fund lives. They're thinking about what their marks are supposed to be. When am I supposed to be marking things down? How do I write those down? How do I have that conversation with the allocators and the LPs? And this is true in crypto and not crypto. And so we, to your point, have a unique part of the market where we're getting feedback quicker on our token investments, and they're going public, quote unquote, earlier, and we're getting price action because of that. But either way, we're all in this place where people are concerned about venture broadly with a rising interest rate environment and risk on assets being repriced appropriately. And so I think it's crypto venture and some of the reaction that's happened looks not that dissimilar from the rest of the market, at least from my perspective.
Yeah, I don't have a whole lot to add. I think that's true. What you're feeling is just VCs have customers, right? And their customers are their LPs. And the reality is, if you don't know where your next kind of like your lunch is coming from, you're going to deploy more cautiously. You're going to think about where you do. Your behaviors will shift. So you mentioned markups. You might want to lean in to support an existing investment as opposed to swinging at a new bet. I think, at the top of the cycle, you saw a lot more entrepreneurialism in VC. So you saw these kind of like emerging managers raise small funds really swiftly to have niche expertise. That bodes well for entrepreneurs that fit within that, right? If I'm raising for a really specific type of gaming fund or something, I think in this environment, when people are more cautious, they defer to those firms that they've seen do it many times over. And you just see a little less like new entrants into the space.
A flight to quality, so to speak.
TBD if size is quality. I think the irony is probably in anything, the higher AUM, higher capacity, your investment universe is constrained. And statistically, that usually means worse returns. But I think it's defensible, right? So if you're a pension fund and you already have high exposure and you're going to write another VC check, it's in the same way it's easier to write, go for Blackstone's next fund if you're already in the others. You feel that you can take that to the board a lot easier than backing a first-time manager or a new strategy that you have no exposure to previously.
It's always easier to write a check into somebody you already know, that your investment committee already knows, that you already have a relationship with. And I think we've seen this where there are people who have, an allocator who has maybe 6 managers in their portfolio who realize this space is not big enough for me to get actual alpha with 6 different managers. And so what do I need to do? I need to pare that down to who is actually quality, right, to your point.
For the sake of weighing in, I'll add a slightly more controversial view on why it is different in crypto as opposed to the broader market, which I agree it follows many of the trends of. But in reality, crypto venture capital before 2016 didn't really exist, right? There were no funds who were set up with a dedicated strategy, at least on the venture side, so predating many of the crossover liquid strategies who were starting to allocate more to private markets and early stage token opportunities. If you do the math right, that means within a 7-year period, that is the extent and life of most of the venture funds. I assume all of us are in that bucket as well. And reality is most venture funds are structured on typically a 7 to 10-year period. So realistically, most VCs in this industry have not returned outside of specific distributions and dividends they've paid out along the way, have not actually returned the capital that was committed to them on day zero. And I think that's a very unique dynamic that we have, which is linked to the opportunity set of this sector, industry, movement, or whatever we want to call it, was certainly perceived as, and fundamentally believe it still remains to be, an outlier sector which will continue to grow at a faster rate than anything else. But the reality is that so much happened in such a short period of time that not many people have actually been able to show credibly track records of returning capital to LPs, and ultimately that's what matters to LPs. They want to see that money coming back. They want the track record of exits and dividends and distributions paid out, and frankly there's not enough people in the industry who have literally had to come to that point where they're starting to exit positions.
I think there's the vintage that we're in, which is started in the dearth of 2018. I think there's a decent amount of funds that have DPI from that, but outside of that vintage, I agree with you. There's no DPI in the 2020, 21 funds.
Exactly.
The other difference I want to mention is really when you think about how the valuations of the Web2 investments are going to be impacted by interest rates, you have a unique opportunity to invest in protocols that are disconnected from DCF models, that have tokens that are not securities and are not going to be valued like securities. And so when you think about that, think about the opportunity in the next 5 years when interest rates are going to come down, but not as much as we've seen before.
You talked a little bit about exits. If you were you said backstage, if I were an LP, I'd be asking about the exits, but you don't really have to worry about that because you invest in tokens. So can you talk a little bit about that?
Well, I think, as Lior mentioned, a lot of the investors did not manage dynamically their exits. So when they got liquidity from a token launch, they just held on to the tokens without taking risk off the table. And sometimes, even if you come very early, you're not going to make the multiples that you're expected. So I think if you're investing in tokens, you really need to think about that and about opportunities to stake the tokens that you have and get additional returns. I think for the exits in the pure Web3 equity projects like DAO tooling or developer tools or things like that, the exit are going to be really difficult. We see a lot of applications that are being built. Also, that's going to be difficult. I think the easiest exits we see in the space are really the financial infrastructure, the custody, the exchanges, all that, which is more attuned to traditional business models.
Anything to talk about exits?
Yeah, I think through this cycle, I think this space will mature out of it. And I mean that from the investor mindset, that you do have to ask, and LPs are asking you, where are their exits kind of that are nesting or like, what is it called, kind of, ripening in this portfolio. And you start to see that for some of them, I think especially because of crypto, there are companies that it's a lot harder to see that pathway, because either there's a regulatory issue that feels like it would preclude a public listing. There's not a natural acquirer. You have a lot of stuff that started as open source, right, where there's IP issues around an acquirer. And so you sort of step back and you think, do we have so many in the hopper, or how do we help them find that path to? And I guess it's probably dividends, right? It's that you hope that in a strong market, they become a profitable business and they return capital in that way. But it's certainly just something, like when we even look at deals now, I find in a way I was never doing years ago, saying that another criteria has to be really what is the path to any liquidity on this. And if you're making a bet and you're saying something like, well, at the top last time, their competitor could have sold, then you have to ask, what is it about this team that makes us think they would seize timing? Right? What makes us think when so many others have failed? And to Vanessa's point, in the same way as investors holding on, kind of held on at the helm, right? Had hubris and said the next valuation, higher, higher. So you're adding more probability into the equation, and you need to be aware of that as an investor. It's not just is it a good idea? It's sort of, how would you get cash out?
Yeah, I mean, crypto VCs have historically been quite bad about thinking about liquidity and exit. And I think that's in part because, there's a lot of hubris, especially when a lot of crypto VCs were, actually coming in and getting established. But I do believe that part of it has also been, there's like an incentive structure misalignment that happened, especially when there was this idea that I do an early stage deal, I get token liquidity, and I trade out of it. And now, VCs who are typically partnering with early stage companies, and they're helping them build, and they're helping them, recruit talent, and they want to see them over the long run, are saying, hey, I did your round, a year ago, and now the market's run up, and now I'm going to trade out of your position, and treating it more like a hedge fund than a VC. And that's created a little bit of a push-pull that when times were good was fine, but now you need to be more thoughtful about, and the projects and the companies themselves are thinking, who do I actually want to be part of my cap table, or I want to have a long-term partnership with? And we're starting to see a lot of the protocols themselves, by the way, who maybe had tokens originally, maybe splitting, the equity and the token from a foundation versus a kind of labs corp or something, or raising, even though they are a application and a DApp and they have a token and governance token and all that, are actually raising into an equity company now, because they are trying to be more thoughtful around incentive alignment, which I think has been something that we've all still been figuring out as an industry over the last couple of years.
You mentioned hubris. How can you compare this cycle versus maybe previous cycles in the past? Because like you said, this industry is so young, and it's been mostly bull run for the past few years. So
I think the previous cycles all happened in a zero interest rate market. So it's really interesting. We've had 15 years of bull for everyone. And so I think it's the first time when, the narrative that crypto is a hedge and everyone's going to fly to crypto when interest rates go up. We see that's not the case. Everyone is risk off. So investors are just risk off. And so we need to figure out what's different and what we can bring to the table that's different from traditional tech or other open source projects. I think it's a great time to test the next cycle of halving and see if that was true, that holds true in high inflation markets. I think, having gone through the previous crypto winters, this is night and day. We have, billions and billions that have been poured into projects, infrastructure, protocols, hundreds of thousands of developers working on these projects, and a true aspiration. Now, we've seen the attention shift a little bit to AI, but we've seen that people understand, institutions understand that this is going to be the next version of the financial infrastructure. Enterprises understand that is the next version of how they're going to interact with their clients and incentivize them to come to their brands. So I'm very positive at what's going to come in the next 10 years. I was just in New York and speaking to a lot of institutions who are not saying much, but I think they're well prepared for the ETF launches and other trading and other tokenization perspective. By the way, RWAs and tokenizations always come back during crypto winter. Like, we don't know what to do, or we're going to do tokenization. So, but I think this year around, the institutions are ready.
So I just quickly weigh in on this, because I think it's a common misconception, and there is a lot of reasons for us to be pessimistic about the outlook at the moment and the state of the industry. I think the reality is people have had a lot more to lose in this last cycle, right? Fund sizes were bigger, wealth that was created was larger, and therefore when you feel the dips and you see the losses on paper and in your pocket, it feels very different. But if we actually look at many of the landmines, let's say, that have happened over the history of this industry, I mean, the price correction that happened post Mt. Gox and things along the way, prior, again, if we go back before 2017, for us to only have been down, and talking, let's say, BTC, ETH, for things to have only come down 50%, let's say, post what we saw in 2022 last year, which was a whirlwind and multiple level catastrophe in literally every aspect of this industry, speaks a lot to the strength and resilience of this industry and the community behind it and people's belief in it. And yes, of course, every winter's different, and I agree, we keep coming back to RWA and real-world asset tokenizations, always sexy in a bear market, but things are not that bad. And I think we need to recognize that the level of sophistication and market participants has actually come a long way, and that's a very positive thing for the long-term trajectory of this industry.
Yeah, and I think separate from prices being resilient, another reason to be optimistic would be when capital is too cheap, you just have a distortion in markets, as in you fund things that don't have a right to exist, right, in a normal environment. And that should tell you that when the competition for capital is more fierce, right, in the same way equity markets still play out, you have more of a balance, a swing back to value, you should see projects normalize, right? Capital should go to better things, and that should also elucidate what really has legs, right, as a business, as a use case in the space, and what doesn't, right? And I think we're starting to see that where, okay, things that are more sensible get funded at the right prices, and that's usually a good thing for actual development.
Well, that's a great segue then. So where's all the money going, and what are the really exciting, innovative projects? I know before we came down here, we talked a little bit about Asia and how exciting that region is. Rob and Lior, especially, talk about that a little bit.
Yeah, I can start. Where's the money going? Listen, I think there's basically two different markets right now, right? So there are, the very crypto native group of investors who have been around the space for a long time that are constantly looking for what is the next tech innovation, right? So we see a lot of that focus and mind share happening in things like different types of cryptography. We see it happening in zero knowledge. We see it happening in things like decentralized sequencers, and this technology infrastructure that people see as maybe enabling a kind of new paradigm within crypto. And outside of that, you then have who are the very traditional financial savvy people who have entered the space or are doing this kind of part-time as part of a broader mandate, and things like RWA are top of mind. I'm old enough to remember when Blythe Masters on the front of Fortune, I believe it was, and said blockchain, not Bitcoin in 2015. That seems to be a conversation I'm having again with these large institutions. We see it in, and in stuff that's easier for people to understand. So trading infrastructure that's more regulated and pulls apart, the brokerage and the exchange model and the clearing model, wallets, things like that. But I do think there's also, the geographic point, which is Asia versus the West. And the West is definitely very institutional access, institutional infrastructure focused, and there are a lot of people spending time on that. And the East is the only place where you see, at least in my perspective, people excited about consumer applications, right? And part of that's because in the East, they view trading and gambling and gaming as kind of the same thing, and people do it interchangeably, and it's all fun. But it's a very different mindset, the approach there, and it's a very different way to invest in types of things that are seeing traction there than there is in the West, where it's all kind of institutional infrastructure. But I don't know if you...
Yeah, no, fully agree. And just, to provide some context and color to that from the Spartan side. So we have 2 dedicated venture funds. One's focused on DeFi, basically trustless networks for the financial infrastructure, which I think is second nature to anyone in this industry and what we're trying to do and achieve. And the second is gaming, right? And I think that the whole thesis around why gaming is important and why there is an appetite for things beyond just the financial fabric itself is because at some point, we need applications and reasons to be using this fabric that we've all been creating. And the term infrastructure in this industry gets thrown around endlessly. It's exciting. It's a great way for people to not be able to price things and see limitless upside potential on your investments. And very much excited about that as well, because fundamentally believe that this is the infrastructure and fabric of the future of all rails that we work with and transfer value on. But at some point, people need to engage in that. And the way we engage in these things is far more sophisticated than just myself as a retail consumer buying and spending money and transferring assets. I do a lot more things with my time. There's a lot more ways to engage in that. And I think where the industry has struggled to date, even some of the original projects like Brave Browser, for example, been around for a long time. A lot of these applications have just never really gotten the full momentum and community support to actually compete with a Google Chrome or be better than that. There's a lot of people who are deeply passionate about this space, but still have never actually used a Brave browser, for example. And I think those applications need to come from second nature. And what I see in Asia is exactly this, let's say, dichotomy between the two is, on one hand, there are applications being built which are non-crypto native and inherent in themselves. And then the other side, which is, again, let's say the non-regulated side of financial markets, as you've said. And then there's a lot of people in the West, and especially Europe and more regulated oriented places, which are still focused very much on the infrastructure level. How can we do these things in a compliant way, which looks a lot like just replicating the old world, which, frankly, how exciting is that? I have my questions and reservations around that too.
So
What's exciting?
I think you need to look at where value capture is. So it's either in deep tech, either on the consumer and end user side, right? So these are the 2 things. And so on the deep tech, it's the protocols, the infrastructure, the ZK, very exciting. I think everyone should just be spending their time there, as I do. But I think that's where we see the innovation right now, and that's where we see an innovation that can be monetized, unlike what happened with Web 2. And so I think spending time on the infrastructure, on the oracles, on the protocols, and we've seen a shift towards the EVM infrastructure, especially after the Luna and FTX collapse, because where are all the developers? Where are all the transactions? Where are all the exchange of value? They're on EVM chains right now. And so we've seen a concentration and the confirmation of Ethereum as the global settlement layer. And so a lot of innovation is going to come from that space. I think on the end consumer applications, I think if you're trying to build Web 2 equivalent consumer applications on a Web 3 stack, we're not there yet. However, if you want to build like financial infrastructure for the existing incumbents to come in, to have custody, to have the crypto rails, and if you think of, I think that's also very interesting. If you think of payments, what are we going to squeeze out of the fintech payment space right now? The only innovation they could have is crypto rails and crypto innovation to make it more efficient. So I think there's tons of opportunities, but there's different ways of seeing where the value is going to be in the short term, medium term, and long term.
I'm surprised you say payments when we were talking about exciting things. Like, can't really think of anything more boring than payments.
PayPal, who's creating a stablecoin on Ethereum. And then the other thing, which I think is different, I'll come back to your previous question, what is different from the previous crypto winter? I think open source won. I mean, this enterprise chains, et cetera, they're just not getting traction. And so when you see a PayPal launching a stablecoin on Ethereum, you understand that open source has won. And in the future, everyone will tag their applications and their infrastructure on open source software, like it has done on the Web 2 stack.
Sam, what are you excited about?
Yeah, I'm just thinking about kind of the infrastructure application discussion here. I think, sometimes when VCs try to defend their contribution to this world, they'll say, well, we fund innovation and we fill a gap the government can. And I think I do feel now there's that trade-off here. Like, there's more liquidity because a lot of this infrastructure stuff has the tokens, I guess. And I'd say cynically, it frees investors like us from making a real bet on adoption in a space with a use case. When you can say something like, I back, and I did this for many years, like I back the plumbing. Like, I'm not making a bet, but however it goes, I'm in the plumbing, right? And it's like, take some balls to actually, like this guy, I guess, saying like, I'm going in for this game, right? Not like one of the 5 infrastructures for the games. And so I do feel like that we have that, if the next cycle is not just the same speculative, there has to be more that have the gumption to back a real application. And probably that means founders that look different, right? It probably means less a guy who says, I want to do another layer 1 because I also worked with the team at Facebook and my 2 other colleagues did one, so I should too. It's going and finding a guy who's a domain expert, right? Who's like, I'm in biotech and I'm really pissed off that I can't share my trial results with the guy at Pfizer, I don't know. And going to him and saying, do you have a playbook for how this technology can help, if you believe in it? So I hope that the next cycle looks different in that way.
To that point, though, I do think the cycle has changed a little bit, and this is kind of an offshoot, but what I have seen anyway is in 2021, and I think we were talking about this a little bit earlier, but how there's a lot of club deals, and everybody's like just getting into everything together, and we're like the whole market's going up, and we're all going to be we're all going to do well, and et cetera. And what I've seen this year that has changed is people are saying, okay, where am I going to make a concentrated bet, and I'm going to actually act like a VC acts typically outside of crypto, and that's actually the change I've seen from at least the most successful, to the point about have and have-nots earlier. People in the space, and I think it kind of reiterates your point.
We have a question from the audience about altcoins. So, considering increased circulating supplies, particularly due to VC vesting, do you think smaller altcoins can rise again, or will token inflation prevent this? Vanessa.
I think each token has its own token economics, and some get it right, some don't get it right. I think we won't see a lot of the altcoins recover as much as the blue chips at this stage, because if they don't have traction, if they don't have their token economics right, I don't think they will be able to rise as much as they did before. But there are some cycles in the investments, so the blue chips rise and then the altcoins come in. So it really depends on your risk appetite and if you think that that it's going to rise to where it was, but I'm not sure.
I'll add, my 2 cents on this and what I think the challenge in the industry, my answer to this would be it depends on what time frame you're looking at, frankly. The challenge that we have is a lot of the projects, especially in 2021, who have raised significant amounts of money, they raised at a, let's say, healthy valuation that was effectively priced into what they were doing, and that's where their books are marked. Realistically, the price they paid for that token is not the price that this thing gets listed at, assuming that happens within the 4 to 5 year vesting schedule, because what you've bought in 2021 was a locked token for that period of time. So you've paid actually a much higher price for that token. And when people start looking at what the price gets listed at and where it's trading at, it becomes a very difficult thing to reconcile because you're seeing this thing trade, to be honest, this year 80% down from where it started, and you're still holding a locked position on that token, which means you're more than 80% in the red on what you're holding. It's a very difficult thing to reconcile. So I think the reality is the industry will become a lot more sophisticated and adapt to those realities, which sounds so intuitive now. In hindsight's always 20/20 and very clear to everyone, and maybe we got carried away at that period of time with some of the valuations. But I do believe in the notion and concept of aligning incentives between token holders, be it VCs, professional investors, and members of your community and ecosystem, and contributing to that structure of a long-term success of a project. And that's what this whole movement and space is about, is aligning those interests. So I do think over time, the price action will correspond to the right incentive structures. I just don't think that we got that right in the last few years.
We're out of time. Any closing remarks that I didn't ask?
No, just want to share that it's still a very exciting industry, and I hope that everyone here is convinced of that, and that the future will be an exciting one.
Yeah, I think there's no doubt, to your point earlier, that this feels very different than the last time everybody was concerned about where crypto was going. And I think both from an innovator's perspective and a capital allocator's perspective, we still, I'm very encouraged by where we are today, even within the broader macroeconomic and price action.
Is that because of the institutional interest from this time versus last time, or more?
I think it's in large part because of that. Because there's not, when 2018, when Bitcoin went from 19 to 3, I think, I was still working at a large traditional financial institution at the time, but we had been talking about crypto for our clients, and everyone said, they wiped their hands and they said, that was fun, we're going to go home, let's get back to our real jobs. And that is not happening now. And people are positioning themselves for what they believe is, essentially a new paradigm of open source software, which is what crypto is.
Yeah, and also the regulators, as you've noticed, are paying attention. So why would they pay attention to this, multi-small billion-dollar industry if there was not a real change that's being brought to the financial system, to the way we interact with value, et cetera? It's not a threat to the existing system. It's going to help the existing system be more efficient and bring more value to people.
Thanks for joining.
Thank you.
Thank you very much.